and our corporate supporters and corporate members, may I request all to stand while we play the ICI motto song.
You share the audio, Ashish.
Thank you. Please be seated. May I now request Chairman C.A. Sajiv to deliver welcome address.
Thank you, Ashish ji. C.A. Atul Gupta ji, past president of ICA, our chief guest for the day. Thank you, sir, for joining us. And the entire managing committee, we recall and humbly thank for your all support, strong support during your tenure as a president of ICA. CA Sanjay Gulani ji, the speaker for the day. Dear members of ICI, welcome each one of you to the session on stable income in unstable world, which we believe an apt subject for the time. And the MC feel this would be a knowledge enriching session as you delivered at ICI Bahrain. Once again, the managing committee of ICI, we welcome each one of you and wish you all happy learning. Thank you so much.
Thank you, C.A. Sajiv. May I now request C.A. Unmesh to introduce Chief Guest C.A. Atul Kumar Gupta.
Good morning, everybody. C. Atul Kumar Gupta, sir. Everybody knows him, but as a formality, I have to introduce him. C. Atul Kumar Gupta is the past president of the Institute of Chartered Accountants of India. He has served the accountancy profession for more than 2 decades and is widely respected for his strong organizational skills and deep insights in the affairs of the profession. With deep interest in his research, he is credited for the project of preparation of the accrual-based financial statements for the Indian Railways. With his diverse and deep knowledge, he has served in various governmental bodies in the past. He has been first chairman of the Accounting and Financial Services Section Committee, constituted by the Bureau of Indian Standards. On the international front, he is on the board of International Federation of Accountants, XBRL International. Being thoroughly conversant with the professional concerns and demands of his time, C.A. Gupta has authored many relevant books and has published numerous articles in leading newspapers, magazines, and professional newsletters, and delivered lectures in about 600 plus seminars and conferences. With this small introduction, I hand over the stage to you, sir.
Thank you, Ashish. Thank you, Bhai, brother. And thanks to the Honorable Chairman Sanjeev ji and all the management committee members for giving me this honor and the opportunity to participate in this wonderful event. I attended the event with Sanjay Gulani ji in the Bahrain as well. And the way that he explains the various nitty-gritties of the investment vis-a-vis the ecosystem around that, I believe that this will be a great and wonderful session. And this is the second time that I'm joining the dais with the Sanjay Gulani ji at the this particular program being organized by the Muscat chapter of ICAI. So at the outset, thanks to each one of you. And I also acknowledge all my participants, colleagues who are participating in this program, and specifically the two dynamic chairperson of the Muscat chapter with whom I worked as a vice chairman and vice president and president. The Madam Ashwin, I was discussing before we just started the program, that the way that the she pushed the various initiatives under the Oman chapter and then later on by Mr. Prabhu. But now the new team with the under the able leadership of Sanjeev ji, I know him that how dedicated he is, and the way that the CBFS we are trying to have the more and more relationship with the CBFS. I believe that time has there is we are not far away when we will have the more and more recognition of the Muscat chapter in the international arena. Friends, as far as the profession is concerned, I can speak for hours because you are aware that I remain the president, and when you are working as a president, you have a lot of vision and you have a lot of aspirations or something. And when you are very closely associated with the profession, you can speak many things. But today the topic is about the investment, the stability of the investment, and the better way of getting the returns around that. So I will not be touching more things, but only few things I wish to just give a message to the chairman and all the management committee members and all the members here. The first thing is that the exam center, and I believe that today we have the exam center in Muscat, if my information is correct. But if that is not the case, I believe that we should have more and more that the exam center with all the different stages should be there in the in the Muscat. And apart from that, just to share with you, Sanjeev ji, that in 2020-21, we passed the international curriculum. And since there is no Institute of Chartered Accountant or the professional available in Oman, I believe that this is a great opportunity available that under the collaboration with the CBFS, if you can launch the international curriculum of the ICI, and you can be the first country in the world wherein this kind of a program will be there. So just to share with you, when the international curriculum of the ICAI will be there in the Oman, what will happen that the entire curriculum will remain same as if of a ICI, but certain specific papers related to the Oman will be there in the part of the curriculum, and that will help not only the articleship training but also the other type of training. And then practically what will happen that it will be that the way that the this Oman will have its their own way of developing the professional body. Even you can visualize that in case we can develop a ICA Oman, where the Institute of Chartered Accountants of Oman or a CPA Oman, wherein the role the professionals, our professional colleagues can play, that will be a very important, because later or sooner it will see the light of the day. And in case we can initiate, we can endeavor, then I believe that the recognition of our professional colleague will be much better as compared to that the Oman government is bringing certain institution and then we will be there. I'm aware that the management committee under your leadership, Sanjeev ji, is doing a lot of things. Even the exam center, I recall that is there available since 2014 in the Muscat and Oman. And I remember the day when it was very difficult to conduct the exam in 2020 in the midst of the COVID. But yes, you stood like a rock with me, and we are able to conduct the examination in all the overseas location, even including Uganda, where only the 2 students appeared in the exams. Now, my dear friends, as I mentioned you that there are many things which I can discuss, but this is not the right place or the occasion when I will be discussing about the various professional aspects. Now, the topic as such has been given is the stable income in the unstable world. I will say there are we have the very dynamic personality, Sanjay ji, who is going to speak on this topic in length. So I will be just touching upon two aspects which I even discussed at the very conference as well. Number one, that the portfolio, how we are developing a portfolio which is a balanced portfolio. Because normally what is happening, Ashish ji and Sanjeev ji and other my colleagues here, that normally what is happening, that we are creating a portfolio which is more risk, kind of a more risky portfolio is at times. So it's very, very important that we are developing a portfolio which is having a balanced kind of a things, that there is a risk, yes, there is a risk appetite, but everybody has to see that what kind of a risk appetite I carry. And based on that, we should, so हमारे यहाँ पे कहा जाता था कि जितनी चादर हो उतना पैर फैलाओ. So same way it should be like that. Okay, in case we have a risk appetite up to this level, we should do that level only. And today I will say there is a stability. When we are talking about the stability or the unstable world, there are the economies. For example, the India, the way the India is performing, that today the India, as being discussed, that will be becoming the third largest economy in the next 5 years down the line. And the way that the promotion to the industry, the promotion to the trade is happening, I believe that the even a portion of our investment in India will be giving a stable return in the times to come. Similarly, there are the other economies which are getting into the getting developed, or even the instruments which are getting the developed, which can give us a very stable kind of an income, which I believe that we all are aspiring for. The another aspect which I will take little more time to explain, maybe not only 2-3 minutes, but just to explain you, because that is my passionate area, is about the consideration of the ESG. That is the sustainability part, the environment, sustainable, social, and the governance part. That is called the sustainability in a single word, into our investment portfolio. Because I just wish to share with you, I shared many data over there that when I was there in the very, that how the total money, that the total investment portfolio, how the total portfolio, out of the total portfolio available with the investors today or with the mutual funds or the other organizations, how they are taking even up to the 70% level, where they are considering the ESG aspect when they are investing into the company X or a company Y. I'm just sharing with you that the earlier, the ESG concept was like a CSR concept, that's the corporate social responsibility, wherein everybody was looking that it is a moral value for me, but ultimately it is a duty of the governments, the regulators, that they have to take care of the ESG aspect, they have to take care of the climate aspect. But now, rather than the values, it become the value proposition. So I used to say value versus values. So whether the ESG is for value or for values, now the values part is now the days are gone when we are discussing ESG as a values. Now it is more the value, because what is happening, Shilpa ji or Sangeeta ji or anybody I take the name, that it is becoming more the value proposition. Now, in case your company is there, I'm just giving an example, that if the company is there, X company is there, and they are performing poor into the ESG score. So they have the poor ESG score, they are not meeting the ESG guidelines, or whatever the investment they are doing. For example, you are doing a more investment in the coal mines. So what will happen, that the a section of investors will not invest in your company, and in that way, even the regulators are saying that, okay, for example, the RBI in this the Indian Bankers Association, I'm just talking about the India for a minute, that the Indian Bankers Association issued a voluntary guideline that, okay, wherever will be the borrower, a large borrower is there, say for example, of a more than 200 crore of rupees, I'm talking about, that, okay, you have to see that they are voluntarily complying with the ESG requirement, meaning thereby, if the time will come, like a CIBIL score, I just wish to connect you, the Umesh with the CIBIL score, like we are doing, that today if my CIBIL score is say 750, I will get the rate of interest at the rate of 8%, in case I am doing a borrowing. But in case my CIBIL score is 650, my rate of interest will be 10%. Similarly, if my ESG score will be poor, in the times to come, the cost of capital will be more costlier for me as compared to that will be there, that will be. Even I tell you that we have an organization called Shell Foundation. Now the Shell Foundation is giving the credit, offering the credit exposure, even just for 2% rate of interest. On an annual rate of interest is 2% in India. in case you are doing a further credit to the ESG projects. Say, for example, for a e-rickshaw or for a solar project, then they are offering the money for a 2% rate of interest, because ultimately one is that they have to comply because they are a negative ESG. They have the Shell Foundation is an oil company. They are doing a lot of carbon emissions. So to set off that, they need a carbon credit. Number one. Number two, they are aware that, okay, if they will not comply with the ESG, tomorrow the investment will not come in their company. So ultimately, to make them the ESG neutral, what is happening that they are doing this kind of a funding at a very low rate of interest. So what I'm trying to convey, that when you are taking an investment decision, you have to consider in the times to come, maybe 2 years down the line, maybe 5 years down the line. But the days are not far away, Gauravji or Badriji, that when you will be investing as if I'm not aware about the ESG. No. In the next 2 years or 3 years or 5 years down the line, you have to see that whether my portfolio carries the ESG impact fund or not. The specific funds which are getting created, because ultimately they will grow more. Now the more specific products, specific mutual funds, specific funds are getting created which are related to only with the ESG. And I believe that Sanjay ji also touched upon this aspect when he spoke on the very that in the times to come, everybody will be taking care. Even when the product portfolio, they will, like a Sanjay ji will be investing, they will also consider in the times to come that, okay, whether they are scoring better on the ESG front or not. So that is something that we need to take care. So in case for a short term, certainly, yes, you will see the rate of interest, you will see the whether the money is safe or not. But in the long run, I just wish to share with you, when you are looking for a long-term investment, please consider the ESG factor also when you are looking for a stable income, because normally in the normal short period, anything can be can give a stable income. But in the long run, only the survival of the fittest will be there. And the survival of the fittest today, the fittest definition includes the ESG aspect. So that's why I mentioned you that I will take a little more time to explain you why the ESG factor is more important in today's environment. So my dear friend, I can speak many things, but we have the very distinguished speaker, Sanjay Gulani ji, who is ultimately the star. I will say that the star of the day. That, okay, in any case, he is the star, but today he is his day rather than myself speaking more and more. So I just sign off from here and convey my sincere thanks to Sanjay bhai and all my respected colleagues from the Oman, Muscat. I remember, as I mentioned you, I have the fond memory of visiting the Oman maybe twice or thrice with all these vibration you all carry. So I even miss at times visiting, because whenever it will be the opportunity, I will personally visit Oman as well to again feel that vibration of my colleagues, that the dynamism you have, all your workings, whatever you are doing. So my great, I had like a salute to all of your contribution, because ultimately you all are the volunteers on based on which the ICI is flourishing and making this a vision that by 75th years of ICI, we will be available in the 100 cities of the world. So my best wishes to all of you. Thank you very much for giving this opportunity.
Thank you, CA.
Thank you, Adilji, for wonderful words and praising us for our wonderful efforts. And all the time, you're welcome. You're welcome, and we are waiting for your next visit. Hopefully, we will have it soon. We're waiting for that. Thank you so much.
May I request now CA Badri to introduce our speaker, CA Sanjay Gulani.
Good morning, everyone. Myself, Badrinath Subudhi. It's my pleasure to introduce Speaker of the Day, CA Sanjay Gulani. CA Sanjay Gulani is the founder of the Silverdale Group and Chief Investment Officer of Silverdale Fund VCC. Sanjay is a Chartered Accountant, Management Accountant, Company Secretary, and Solon Fellow of Management from the London Business School. He has over 30 years of investment experience and manages over $1 billion in fixed income assets. Silverdale funds have been ranked among top decile bond funds in the world, winning several accolades. Sanjay takes pride in his firm excellence in delivering end-to-end fund management solutions for family offices, independent asset managers, private banks, and institutional investors. Earlier, as managing director of Silverdale UK, his firm channelized over $4 billion of investment into emerging markets, including in joint venture with Goldman Sachs, Morgan Stanley, and Lehman Brothers. Investing is a passion for Sanjay, and he has been a frequent guest lecturer at various business schools. His expert opinions are widely sought by the media, from the Wall Street Journal to the Straits Times Singapore to Channel News Asia, from CNBC to ET Now and Radio FM. He is a regular speaker at various industry forums, has made several presentations, including at the United Nations. With this brief introduction, I hand over to Mr. C.A. Ashish for the rest of the proceeding. Over to you, Ashish.
Thank you, Badri. Before we start Sanjay's presentation, I think CA Atul Gupta ji has conveyed that he will have to leave this program in some time. So may I request CA Sajeev for the quick felicitation of CA Atul, then we can start the webinar officially.
Thank you, Adulji, for your wonderful presence and encouraging words and intro to set the base for the day, the discussion topic for CA Sanjay ji. And we hereby present our e-certificate and bouquet as a token of appreciation. Thank you so much for joining us for the day. Thank you so much.
My pleasure, sir. Take care, sir. Thank you very much, sir.
Thank you.
Thank you, CA Sajeev ji. Over to you, Sanjay ji. We are all waiting for you to hear. So you can start. One request to our members, please, we'll having a question and answer session after this session. So please post your questions in the Q&A chat box below. Thank you.
A good day to each of you. It is my privilege to address you. My very special thanks to CA Atulji for gracing this webinar. We deeply appreciate your untiring support to encourage us to climb increasing heights of our profession. It's your dedication for professional growth which inspires each of us. And of course, I had a privilege of you gracing my other seminar at Bahrain. So thank you, sir, for very much for that. Special thanks, of course, to the Muscat chapter of Chartered Accountants, CA Sanjeev ji, and the entire team, CA Jim ji, Umesh ji, Badri ji, Sangeeta ji, Gaurav ji, Ashish ji, and the entire team, and my fellow Chartered Accountants and friends. We, the accountants, have been pivotal in the human progress and growth. I remember my friend at IIM Ahmedabad poked once to me. He said, Sanjay, have you ever seen debit or credit? You people unnecessarily complicate the life. And my answer was, sir, have you seen your money in your bank? That's, my friend, only an accounting entry. And remember, if we were not there, we would be still living in the barter age where I'll be selling my goat to buy a wheat. So the entire credit you see in the world, the so-called M4, is created by us accountants. Not only we create the prosperity through the credit, we also manage and importantly account for it. So before I begin my presentation today, let me just highlight to you that whatever I speak today is completely idiosyncratic. It is my view. And of course, all of you are adults, so please use your caution. It is no advice or solicitation to purchase, sell any security whatsoever. It's purely for education purposes. And of course, at the end of the presentation, I'll be happy to take questions. We'll begin by giving an overview of the investment world, what happened recently, especially in view of the SVBs and CS of the world. How do you analyze the fixed income? How do you can enhance your returns and create a stable income which will last for long? Thanks to Badri ji, You already know me, what I do is sit out there. I have as C. Badriji had told, I'm the founder and CIO of Citadel Capital. We are Singapore-based fund house licensed by Monetary Authority of Singapore. And importantly, we are a tax exempt fund. Now I know chartered accountants love taxes and be exempt. So I want to highlight that we are under section 13U, which means 100% of our income is exempt from tax. And of course, should you want to know more, happy to take questions at the end of the presentation. So let's dwell upon terms of what's happening in the market. Last year, as you know, was the worst year in 238 years. There's a worst year since 17th century for government securities. Why? Was very straightforward, because of the 19-fold increase in the interest rates. So and this is the fastest ever increase in the interest rate the humanity has ever seen. And for people those who are confused in the 1970s, just to remind you, it was just a 4-fold increase. And it has, of course, 2 obvious implications. The first implication is that the yields we're talking today are very, very, very juicy. So which were come close to zero are very much elevated today. As a matter of fact, the yields on investment grade bonds compare favorably as compared to dividends from the equity shares. So they are very, very sexy. All of us understand it. So the obvious first question is that, Sanjay, the yields are high. Why can't they go higher? Fair question. The interest rate is high. Why can't it go higher? The answer is that the reason the interest rate was increased was primarily because the inflation was high. And we do know the inflation has come down in terms of headline inflation from 9.1% to roughly about 6%. But what was bothering the world was more in terms of the core inflation, which is very much sticky around 6%. And only recently has come down to below 6% to 5.5%. What we do know is that roughly about 32 to 38%, depending on counting it, of your core inflation comes from shelter. And we also know that shelter lags rental by about 6 to 8 months. We already know shelter has come down. So apologies, the rent has come down. So shelter would also come down. And that is the reason why, if you notice in last 3 meetings, the Chairman Powell is talking about the inflation ex shelter. So in terms of inflation, we are on a gliding trajectory downwards in terms of the future. What has to be, of course, looked from caution point of view is 2 more important things. First is energy, which currently is a deflator of inflation, but one has to be careful. The good news is, as C. Atulji was mentioning, because of the huge emphasis on ESG, we have a significant portion of energy now coming from renewable resources. So that gives a huge amount of cushion to us. What has been bothering people at large is in terms of the unemployment. I want to highlight this fact that, the people believe that there are a lot of job creation happening in US in particular. That's not necessarily so. I want to particularly highlight the numbers which were given for the month of Jan-Feb. When they talked about 517,000 jobs being added. No, my friend, jobs are not added. What actually happens is this. Between the month of December and January, roughly about 2% of the people are laid out. This year, because of warm weather, instead of 2%, only 1.6% of people were laid out. So there was less disruption to mining, less disruption to construction, and more people coming out to eat, drink, and be out. So first and foremost, to notice that it is not addition, it is less subtraction. Yes, we know accountants like what it means, but it also means the trend is not as strong as people believe to be. And here is the next more important point. If you look in terms of job creation, almost 92% jobs being created are into part-time jobs. In terms of full-time job, it is flat or marginally negative. If the economy is doing so very well, you want to hire full-time people, right? You do not want to replace your full-time people with cheaper part-time people. That's the key point to keep in mind, that in terms of the big picture point of view, we are likely to get into recession very soon. I'm talking about US and developed markets. And the economy is something which you need to be careful about, specifically in terms of what has happened in last 3 to 4 weeks in the financial world. Therefore, from the interest rate point of view, we are very, very, very close to peak. And as a matter of fact, we have seen actually the interest rate hinting towards the downside. And I'm particularly highlighting to you the short-term interest rate, which is a better indicator in terms of what's happening. So the current elevated yield is something you should look at very, very careful, because such opportunities don't come often. As a matter of fact, this is one of the rare times that the US economy is getting into a slowdown recession, which such a strong balance sheets. So if you look in terms of US consumer point of view, we're talking about US consumer having a excess saving of almost $0.9 trillion. If you look in the corporate point of view, the investment grade corporates net debt to EBITDA ratio is about 2.6. Even for high yield, it is about 3.4. Fantastic, fantastic, fantastic. And if that is not good enough news, here is a point that in terms of the maturities of the bonds in the market, in next couple of years, we have very, very low amount of maturities available. So if you look in terms, if you see the graphics across out there, in 2023, 2024, the amount of maturity you're talking is far, 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 far lower than the normal maturities we look at. We're talking roughly about 8% maturing the end 2024. In normal circumstances, it should be close to, but 15 to 25%, less than half of the bonds of normal levels are coming to maturity. And that's also to a large extent true in terms of the emerging markets. And on top of it, so we talked about strong consumer, we talked about strong corporates, but also in terms of the banks, they are having fabulous balance sheets. We're talking almost 3 times more capital adequacy than they were used to have in the 2008 era, specifically with low amount of non-performing loans. We do understand these will increase, but where we stand today is a fantastic, fantastic position to be in. And here I have not even talked about China, which has done what is called the mother of all U-turns and gone on a huge, huge, huge uptick trajectory. We're talking about a country like China growing at more than 5%. As you know, in the last week of October, first week of November, they did a 16-point measure to support the Chinese property market and put in more than $1 trillion of the QE, which is going to, of course, have multiplier impact in the entire industry. To sum it up, as mentioned by JP Morgan, today you're getting almost 1.5 times more than the risk you are taking. As compared to normal times, you're getting about 150% more return than the risk you are taking. We know that the inflation is coming down. What happens is that we have seen historically, whenever the CPI comes down by 1%, the US aggregate bond index gives you about 6.1% return. And finally, of course, we're talking about slowdown, and I'll elaborate in the next few slides. What we do know is that the best performing asset class 6 months before the onset of recession and 12 months after the onset of recession is always, always, always fixed income. So if you are looking in terms of stable returns in the short to medium term, nothing can beat fixed income. Having said that, we have never seen such a steep Fed rate hike happening without accidents. So if you look in terms of since the beginning of the 19th century onwards, every time we saw such a steep rate hike, we always see certain accidents happening. Broadly speaking, I would classify those big picture number from point of view is in terms of the M2M versus the realized losses and the cracks becoming fissures. And this is a point of reckoning for us, the chartered accountants, in terms of what more we can do to educate the society at large. And let me explain you more detail about this. Let's look into the Silicon Valley Bank. Silicon Valley Bank, as you know, was the bank of choice for almost half of all US venture-backed technology and life sciences companies. Almost half, 50% of all US venture-backed technology and life sciences companies had accounts, banking relationship with Silicon Valley Bank. And as you know, many of these cutting-edge technology firms burn cash, not generate cash. As a result of which, they would typically do the fundraising before they will spend, and the money they raise, they keep it at Silicon Valley Bank. So 93% of deposits which the bank had were non-transactional. So the money is lying with the bank not because there's going to be a trade, there's going to be a consignment settlement happening, is lying in the bank because the startup, the fintech, the regtech, the medtech would withdraw the money. Now, as we all know, that globally, the developed world, and US in particular, did huge amount of payouts at the time of COVID, which is a question mark, but let's have a discussion. But what happened is this: there are too much money chasing, among other, the financial assets, and as a result of which, the fintech and startups raised a lot of money. What happened for SVB was the deposit increased by almost 86%. 86% increase in the deposit. The loan book was very small. They couldn't lend the money out. So what did they do? They invested primarily into long-dated government securities or government-backed securities. To a layman, government-backed securities looks to be a super cool thing to do. But they forget what chartered accountants, as we know, something called structural superiority stock problems. And the problem was this: when they invested, the long-term interest rate was pathetically low. So to take an example, we're talking about 10-year US Treasury to be about 1%. Today, we're talking about 10-year US Treasury to be 4%. 3% increase in interest rate. If the interest rate decreased by 3%, if a duration of 10 years, the mark-to-market loss will be roughly about 3 into 10, 30, discounted back roughly about 25% odd. Here is where chartered accountants come. Here is where the IFRS come. Here is what the accounting problem came. And here is the accounting problem which created the real problem. A large amount of this particular asset was HTM, hold till maturity. Only a small portion was AFS through the P&L. In normal circumstance, it's perfectly fine. You hold $100 worth of security, the market price of that security is $75. Don't worry, government is not going to default. When after 10 years you want it back, you get the $100 back. But what if your depositors want you as a bank to return the money? Obviously, the bank will have to sell the security at 75 cents to dollar, which basically means they would not be able to pay $100. That's exactly what happened. Because of the fact that the securities were marked as hold till maturity, they were not written down to prevailing market prices. Very, very important. So the key point is that when we as chartered accountants were classifying certain investments, we need to be careful in terms of, does HTM really mean HTM, or HTM is basically a convenience, which we saw again, for example, in India, in case of Templeton, with due regards. And this is not the problem only for a specific bank. This is the problem of the industry. We are talking close to about $620 billion of book losses in the books of the various banks. And almost half of this is HTM. And remember, mind you, this excludes $1.1 trillion of unrealized losses in the book of Federal Bank of United States of America. That's something which requires all of us as chartered accountants to think, how do we protect our society from this HTM versus AFS classification and the adjunct risk to it. As investors, what it basically means, the failure of SVB, the Silicon Valley Bank, Signature Bank basically means is this. There is a huge flight of deposits from the smaller banks to the larger banks. Majority of the money from the smaller banks, which is flowing out from smaller banks, is going to larger banks. And of course, a significant also going to fixed income, namely money market funds, which today has risen to mind-blowing $5.1 trillion. I believe it's higher than even GDP of India. What it means, and this is the most dangerous and important takeaway, which is inevitable, which is that there'll be a tightening of the lending standards. The small companies would find difficulty in terms of getting bank financing. Your working capital cost will increase, working capital availability will come down. And just to remind you, while the top 10 banks hold more than half of the US domestic banks' assets, the huge tail of the balanced banks, which are more than 4,000, hold almost $9.3 trillion of assets. These are the small banks which actually are the bedrock of United States of America. These are the banks which contribute 67% of all loan given to commercial real estate sector. These are the banks which give almost 40% of the entire loan to the US economy. And what we have seen is that invariably, when your lending standard becomes tighter, you would have a problem in terms of people being able to grow. You will see the unemployment rate going up. Namely, we would be entering into recession faster. So the first and most important takeaway to you is diversification, diversification, diversification. The shelter is in diversification. And I'll explain you ultra simply. Let's assume you have one investment. The chances of you losing money as a naive ratio is 1:1, 50%. But if you had two such investment, the chances of you losing is only 25%. If you had 13 such securities, the chances of you losing money is 0.01%. Hence, a lot of my friends, then when they come to us and talk about creating portfolios, funds, etc., we always tell, sir, minimum 12 to 15 bonds. This is the logic behind it. The key point is this: there's a tendency of large numbers to converge around the mean. So as long as you are making a portfolio of multiple investment, you would be able to skew your outcome to the positive side. This is the ultimate what happens. Diversification skews the return on the positive side. So typically, you should be talking about 50-50 outcome. Because of diversification, you can get a positive outcome. So the most important message, the first message today I want you to take home is diversification is critical for creation of long-term wealth. And therefore, having a portfolio or a fund would always give you higher return over long period of time. Let's also understand what happened in Credit Suisse and what takeaway from them. More importantly, Credit Suisse, as you know, had weak management oversight. We talked about oversight being weak, both in terms of the wealth products, which all of us know, and including investment banking, where they lost a lot of money. What happens is this: when the tide is low, people know who is swimming naked. So the fissures which were there in the Credit Suisse suddenly become crack when the environment became fragile. And this is the other very important takeaway for you, for all of us, which is the onset of connected world, onset of mobile banking. In Silicon Valley Bank, they took almost $42 billion in a day. And as per Mr. Barr, who gave a statement in the Senate, they could have easily got $100 billion of deposits leaving. How on earth can you withdraw $42 billion in a day? Physically, you couldn't even count the money, right? So key point was, of course, the mobile banking. The key point was internet banking. And that's the reality. And that's exactly what hit Credit Suisse also, where the mobile banking enabled people to suck the money out very fast. The social media rumors spoiled the whole show. And of course, with due regards and respect, the media, knowingly or unknowingly, put petrol on the fire. Be it what it be. The question is, as investors, could we have seen it? The answer is yes, and the answer is no. No, we couldn't have seen the fall of a 167 years old bank in less than 16 hours. But what we did know is in terms of the bonds they held. So if the people, those who were in the market, had focused, they would realize that Credit Suisse did have cracks, which all of us knew. And therefore, it made tremendous sense to focus on the OpCo bonds and not get greedy in terms of going holdco structure without understanding it. If you notice in the OpCo bond, we have almost 100 billion Swiss franc of reserves to support you. So when Credit Suisse was taken over by UBS, as you know, the 81 got rogered, of course, and there's a question mark, and happy to take questions at the end of our presentation. But in OpCo bond, nothing happened. Nothing happened. This is very, 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 very important. Do not get glamorized by the headline. Unsecured debt for 3 months is more safe than secured debt for 100 years. Do not forget that if you're closer to the cash flow, you are closer to the cash flow, full stop. That is the security which you have. Good news? Good news is this. Once you understand the structure, not only could you have avoided the problem which we saw in Credit Suisse in terms of being in the 81s and being at the holdco level, which instantly didn't give you a huge pickup also across that point of time to the risk you're taking. But now, when the event has happened, you could also make monies in terms of convergence. We all know that Credit Suisse rates about 2 to 3 notches below UBS. Now that the Credit Suisse has become UBS, the Credit Suisse bonds, credits will get uplift, get upgraded, right? And that's the convergence trade. So what I want to highlight to you is that as long as you are understanding what you're doing, it makes tremendous sense for you to be able to generate extra alpha. But if you do not understand what you're doing, then inevitably the outcome is not something to be proud of. Second big takeaway for you is please know what you invest into. And as always said, when in doubt, call the doctor. You should use expert to invest. The way you don't go to kitchen and use knives to do a heart surgery. Remember, finance is a specialized job. Please use expert people or develop expertise in order to be able to manage it. And I'm not asking you to become a rocket scientist. I'm just asking you to basically get the basic understanding of finance, of the investment world. I'll quickly run through that, and I'm acutely aware of the time, and I will try to make it much faster in terms of this, but it's very, very important for us to brush up our fundamentals. Because whatever is spoken, you knew. Didn't you know about diversification? Didn't we know about the fact of structural stability? Didn't we know about capital structure? Didn't we know about HTM? Didn't we know of AFS? Answer yes. But did we use it? So let's get it brushing up very quickly. As you know, everybody in this room is a fixed income investor. When you keep money in your pocket, you're a fixed income investor. When you keep money in the bank, you are fixed income investors. When you keep money in the pocket, you forego your interest. When you put money in the bank, you earn the interest. Both is a fixed income call. In a fixed income, as you know, the asset size is about 300 trillion, more than your equities and your cryptos and everything taken together. So as we always joke in our world, we could have your entire equities for breakfast and not even burp. And the reason I'm to highlight is very important. This is understated asset class. This is a bedrock of any wealth management, any portfolio management, any risk management. So it's very important for us to understand it. Out of 300 trillion of the global debt, the emerging markets are about 1/3, about 100 trillion, and out of which the US dollar emerging markets is about 15 trillion. And that's very important to understand the emerging market, because most of us are in emerging markets and there's a huge, huge, huge value in it. In the emerging markets, you notice the one largest, of course, is China. China, as we all know, is slated to be the largest economy in the world, and depending which fund house or investment bank you're looking into in next 3 to 7 years. What you notice is that the amount of Chinese bonds is almost 3 times that of the Mexican bonds, and very important, about 3 times of the Saudi Arabian bonds. I want to highlight the fact of Saudi Arabia. If you remember, they didn't exist, quote unquote, in this world almost 5 years ago. From there, it has become a force of reckoning in the emerging market with almost 1/3 the size that of China. The important thing notice also is this. When you talk about the duration of the bonds, Chinese bonds are typically shorter duration as compared to the Mexican and the Saudi Arabian bonds. In terms of the returns, and quality, what you'll notice is that more than 2/3 of the emerging market bonds are investment grade bonds. I want to highlight this because when I went to school, we were told that emerging market means extremely high risk, high yield, don't touch it. No, my friend, the world has changed. Emerging markets is principally investment grade bonds, not high yield bonds. And as you expect, of course, the investment grade bonds pay almost half the returns that of high yield, which shows again the quality of underlying companies, which, as you see from the graphics, is very, very clear in terms of the emerging markets versus the developed world versus the leverage sector out there. So the interesting question which we, the chartered accountants, need to answer is the emerging markets countries have a better balance sheet in terms of debt to GDP ratio being lower than the developed world. The financials of emerging market corporates is better than the developed world. And yet emerging markets pay you higher return than that of developed world. That is the opportunity for you and for me. And as you recall, in terms of credit rating, so we have 22 ratings. Anything which is BBB and above is called investment grade, and the bottom 12 are called non-investment grade or high yield. We all know how the credit rating agencies do the credit rating based on the probability of default. And I want to highlight to you the probability of default of a 2-year investment grade bond is about 0.23%. I repeat again, as per S&P, the probability of default for 2-year US dollar investment grade bond is 0.23%. Sir, is it better than keeping money with the bank? A diversified portfolio with the probability of default of 0.23% would be brilliant as compared to any bank. Now, the key point thing to note is that when I'm talking about probability of default, I'm talking rating as per S&P, Moody's, or Fitch only, and not local ratings, be it Fitch Indonesia or S&P CRISIL India. Why? Because in a country, the government of the country is always AAA. For an Indian, government of India is AAA. For a Pakistani, government of Pakistan is AAA. For a US citizen, US is AAA. What we do know is United States of America is not AAA, it's AA. Government of India is not AAA, it's BBB. And therefore that reflects in the credit rating. So the probability of default of a 2-year CRISIL S&P rated bond is more than twice, which is 0.58%. And if you of course look in terms of the average, it's almost 8 times more riskier. These are I'm giving you certain pointers which you keep in mind when you're looking into the fixed income world. The other thing I want to highlight to you, of course, is to make a difference between the maturity and the duration. Duration is the period in which you get the part of your maturity or the maturity proceeds out, which basically means after accounting for the coupons. So normal circumstances, your duration will be lower than the maturity because the coupon you receive in the interim period. Generally speaking, of course, shorter the duration, lower the risk. Okay. And now, of course, I don't need to explain this slide, which I've been using for almost 5 years, that bank deposits are not risk-free, which we all know. Yes, there will always be certain politics out there, and that's a different ballgame altogether. But from a professional point of view, very important that you invest into a diversified portfolio. Let me now take you to a very, very important tool for you to increase your returns. And this is very, very simple tool. This is something which all of us can do it, and something which everybody can understand it. And if you were to ask me one fundamental thing which you take away from today's webinar, I'll say this. I know it's very, very, very simple, but that's the most potent tool you have in the entire fixed income world. Let's go step by step. So let's assume a 1-year bond gives you 1% return, a 2-year bond gives you 2% return, a 3-year bond gives you 3% return. Yeah, 1-year bond 1% return, 2-year bond 2% return, 3-year bond 3% return. I buy a 3-year bond. I enjoy at par, of course. I enjoy the coupon, and I want to sell it after 1 year with the residual maturity of 2 years. Clear? So I bought the bond at par. 1 year enjoyed the coupon. My coupon, just to remind you, was 3% per annum, and now I want to sell it. So question is, at what price can I sell it? Okay. So like, let's take, say, CEO Umesh is, he's a very savvy investor. He makes a lot of money, which he doesn't tell to you, but he's a very, very rich guy. So Umesh has two options. Umesh can buy a new 2-year bond. A new 2-year bond will fetch him 2% per annum, which basically means he'll make 2 into 2, that is $4 in next 2 years. But Umesh is a good friend. He's happy to buy my bond. If he buy my bond, which was 3-year bond, now left with only 2-year bond, for the next 2 years, we'll earn $3 every year, namely $6. We all know Umesh is a gentleman, third gentleman. So the price he'll buy my bond is 102. So what happens is this: he invested $102 to buy the bond, and on maturity, he gets $100 back. Namely, he loses $2 in terms of capital loss, but he makes 3 into 2, $6 in coupon. Therefore, his net income is $4, which is exactly equal to if he was to buy a 2-year bond, which paid him $2 per annum. So what I need to do in my life is only this: I buy a 3-year bond, enjoy $3 a coupon, and sell to Umesh at 102. How much do I make every year? 3 plus 2, 5%. Again, buy a 3-year bond, enjoy $3 coupon, give it to Umesh at 102. So the entire Janta is earning 3% per annum, and I'm earning 3 plus 2, 5% per annum. That is the secret sauce of most of the bond funds in the world in normal circumstances. If you keep the duration constant, you would make more money than normally holding the bond till maturity. A very large number of the chartered accountants are also the CFOs and managing treasuries. Very important for them to note it. Selling the bond before the maturity could result in capital gains in normal circumstances. There are exceptions. We can, of course, talk about it later. The next point I would like to rush through, given the time constraint, which is that the return from a portfolio is always higher than the YTM of underlying bonds. Or to be more technically correct, the IRR of the portfolio is always higher than the YTM of the bonds, because in case of an IRR, it is assumed that the money which we get from the bonds is reinvested at the prevailing internal rate. Be careful, because as per University of California, 92% of the fund managers get it wrong. So I'm not surprised, but just be careful about those things, and for this mathematical equation for you to understand. So we talked about, the bond market. We talked about how keeping a duration constant can give more monies to us. And let's also talk about the leverage portion of it. Leverage portion is very important to talk because in most of the developed world and some of the emerging markets, not all, it's inevitable for you to be using leverage in terms of enhancing the return. So first, let's understand what does it mean. Let's simplify. Suppose I buy a bond which gives me 4% per annum, which basically means every year I'll make $4. 4%. Let's assume that I buy the bond for $100 and I can borrow from the bank $200. Namely, I have $3, so I end up buying $300 worth of bonds. On $300 worth of bond at 4%, I'll make $12 per annum. On the $200, assuming a borrowing cost to be 2%, I'll lose $4 every year, which basically means I'll make 12 minus 4, 8% per annum. So when the Janta is making 4%, you can end up making 8% return by using leverage. Very important point to notice. To put simply, if you can borrow at a cost lower than the bond yield, the leverage will enhance your returns. Very, very important point to note. Very, very important point to note. Now, your obvious question will be, Sanjay, hold on. If leverage is going to increase my return, you're talking about permanent arbitrage. And we know permanent arbitrage doesn't exist. And absolutely, you're right. That's exactly the question people have been scratching the head on since 1970s, when we were 80s, when we had the Black Scholes sector out there. Look, why would a leverage increase the return? And the answer was found in the international behavioral finance, where they realized that humanly, you're always scared of something which is not human or can be perceived easily. So therefore, when I close the light in a room, you may be sitting in your room, in your house, on your bed, yet you will feel uncomfortable. Have you ever seen leverage? Can you increase a hand to become of 5 meters? Can you increase your eyesight to go to New York and see right now? Answer is no. So leverage is something which you can't see. And because you can't see it, you have inherent fear in it. And that fear gives you an arbitrage. Or to put mathematically across is this. If you look in terms of the balanced portfolio, which C. Atulji referred to, you typically would take 60% equities and 40% bonds. The classic balanced portfolio, you could have 55, 45, 37, doesn't matter. That's the way most large fund managers in the world have been investing, be it sovereign fund, endowment, or what it might be. And people were like, hold on. 60-40, why is it balanced? Because roughly about 75% of the risk is coming from equities. Sorry, apologies. 75% of return is coming from equities and 85% of risk is coming from equities. Who the hell cares for the input? I want to see the output, and output is not balanced. How can you call a 60-40 portfolio to be balanced when 75% of risk and reward is from equities? And that took a huge amount of research to cut a long story short. People realized that you can actually increase the return without increasing the risk by increasing the amount allocation. So we don't increase the risk, yet your return can be increased simply by increasing your allocation to fixed income from 40% to 200%, from 40% to 200%, which basically means adding leverage. Thanks to, of course, Ray Dalio, it's become very popular in the name of risk parity, but it's something which have been doing in 2010 as something which gives you a fantastic return over a long period of time. And for those who are mathematically inclined, is basically in terms of the efficient frontier being moved across out there to give you higher leverage on the CPM line. Takeaway to you is that 60-40 seems to be a good portfolio allocation from the portfolio allocation point of view. From return point of view, it doesn't make great sense, and you could increase the return by using leverage. So far, so good. So we talked about in the world happening in the world. We talked about the inflation coming down, the interest rate peaking out. We learned from SVB the necessity of being diversification. We learned from Credit Suisse the importance of understanding what you're investing into. We understand from the fixed income space in terms of how the duration works, how keeping constant duration helps. We understood how in terms of leverage can enhance your returns. Now let's talk about making monies. Okay, so let's see whatever I've spoken in action. So if you want to create a leverage portfolio, the way you need to look around is in terms of the constituents. And the constituents, the first and foremost important thing is quality of your portfolio. Very, very, very important. So I've given example of the fund which I'm managing to highlight to you, which is to prove to you that we are high quality portfolio. Typically, the funds you look in the market would have about 55-65% IG. We keep 75% IG. So if you are going to construct it, please ensure the quality of the portfolio is pristine. Number two, keep the duration small. Remember SVB Bank? Sir, we don't want SVB Bank in our portfolio. Keep the duration small. You can manage it out there. And be extremely well diversified. How much diversification? 13 leads to 0.01%. Remember the diversification we talked about? Yeah. So please ensure your portfolio has at least 12 to 15 items. So again, to be extremely well diversified across both the countries as well as the securities, and make sure you don't have a concentration risk. Very, very important. And if you do end up doing it, this sort of returns you'll get. That this is the return, for example, in the last about 9 years, where this is the return which you'll make compared to competition, which is giving you the numbers speak. You don't have to speak the numbers, right? That's the beauty of it. If you are disciplined, if you adhere to the fundamentals of high quality, low duration, well diversified, and understand where you're investing into, not getting into your 81s of the world, of Credit Suisse of the world, this is the returns you get. Would you suffer M2M? Absolutely, yes, you would suffer M2M. But because the duration is small, it does just only a one bump and you'll get back again. So for example, this shows to you that from the bottom, which we saw in November till Feb end, these are returns you make. This is your competition mix. So not only you do very well in terms of long term, even the short term, where as the market stabilizes, you'll make much better. And this is this is a technical point. So be careful there. Technically speaking, a good quality portfolio with a higher yield would provide you a much higher relative returns. This is from again the fact sheet to explain to you, because of the M2M which we saw last year, 238 years of the worst year. Because the M2M we talked about it, we're talking about a YTM, leverage YTM of 13% for a fund of 1.6 years. So this is going to highlight to you how you can add leverage in terms of getting returns. And of course, for people, those who do not already comfortable understanding the risk sector out there, then you can of course look in terms of fixed tenor funds, which will give you diversification and of course preferably enhanced return. And if the leverage is taken by the fund and not by you, there would not be a margin calls. You get of course the steady return. If you are going to construct portfolio for you, your treasury, your company, your family, first and foremost is please be disciplined in terms of creating a universe. And when you create universe, this is how you need to do it. I've just given a simplistic example to explain this to you. It can be more complicated. Look in terms of what geographies you're talking about. Atulji talked about, for example, for India, which of course looks very good. So look from that point of view, what I'm going to invest and what I could invest, and what of course not put on the screen, what I will not invest. I repeat again, what I will invest, what I could invest, and what I will not invest. Those parameters have to lay down day one. if you do not plan, you plan to fail. Just keep the plan in place. And this is again to give a construct to you for people those who are looking in terms of short tenure funds. This is how the diversification works. Again, quality, quality, quality. Diversification, diversification. And of course, once you are in that play, you can create multiple products to cater to all across the way we cater to the institution, family offices, sector. You can do all of those things. Lovely. So let's summarize what we have spoken for us to take home. So in terms of the market, what we talked about is that the bond yields are highest since 2008. And we do know the bond yields at the start of the investment are the most reliable indicator of your investment returns. And no rocket science, right? You invest into bond, which gives you 5%, you make 5%. You invest into bond, which gives 10%, you make 10%. We looked at the opening yields and the return, total return you get during the year. And we did a simple regression of it. So what you see on the right-hand side is that a regression of the opening yield and the total returns for the year. And this is beautifully comes out there. In 2023, we're in a fabulous position in terms of the returns from historical point of view. We discussed that the inflation is gliding down, and we do know when the CPI comes down by 1%, bond gives 6.1% return on an average, right? And as I mentioned, this is one of the rare times that US is getting into recession with a very, very strong consumer, corporate, and the banking balance sheet, which means low default for you. Even if the default rate was to double from here, yet your default rate will be below long-term average default rate, which basically means you're getting superior risk-adjusted returns. And last but not the least is that if you invest 6 months before the last Fed rate hike, on average, you'll make 5 to 15% return. So timing point of view is brilliant timing to have. The other thing which we learned today in discussion was that while the inflation is coming down, we need to be cognizant of the unemployment. We talked about the interest rate be close to the peak. Potential peak is past us, but doesn't matter. We at least close to the peak. We learned from SVB diversification is key to long-term wealth creation. We understood that the IRR of the portfolio shall always be higher than the YTM of underlying bonds. We talked about how the leverage can provide superior risk-adjusted returns. That if you do not know, be away. When in doubt, stay out. In case of issue, call the doctor. Important notice, point to notice, very, very important thing to notice. 92% of actively managed bond funds outperform the index, unlike in case of equities. And of course, huge reasons, happy to discuss if you wanted to. So on a long-term point of view, specifically in the volatile market, actively managed fund can give you better return. And last but not the least, again, is the fact that a leveraged bond, FMP, can give you a bond-like return with fund-like diversification with enhanced returns. As usual, caveat to you, please read the risk factor properly before you invest. My presentation was my personal views and need to be careful because of that. There is no solicitation of buying or selling any product whatsoever. Happy to take any questions you might have.
Thank you, Sanjay. Thanks for enlightening our members. And I like the way you simplified this very complicated bond market subject. Though we have been talking about bonds for last many years, but the way you explained with the example of $100 investment was very nice. We have already received a couple of questions, so I'll read it for you and you will answer because it's there in the Q&A. So I'm happy to go through and then we can take one by one. first question was from Mr. Mukesh Darji. What's your views on de-dollarization, and do you think it is possible? If yes, when 5 to 10 years, and any possibility of international trade taking place in gold standard?
So second question is easy to answer. Does it absolutely unconditionally no? So there's no way we can go back to gold standards. If we go to gold standard, remember my friend from Ahmedabad, I'll be selling my goat to buy his wheat. So given the amount of the trade we have in the world versus the amount of gold we have in the world, there's no way on earth we can go back to gold standards. To give a rule of thumb, the amount of entire gold in the world is about 10 cubic meters. That's all gold we have in the world. So that's impossible to do, and it's not even advisable to do. I'll quote Muhammad Yunus, the Nobel Prize winner from Bangladesh, who told about the poor people are poor not because they don't work hard. The poor people are poor because they don't have the access to credit. And if you get back to gold standard, credit will become next to impossible to create. Coming to first point of de-dollarization, the answer is yes, is inevitable. So what happens if I look in terms of, let me see if I can get you some graphics there. So what happens is that every 1,000 years, the world order changes. So previously, if you know, the Spanish and Portuguese ruled the world, then we have the Britishers who ruled the world. And after the Second World War, of course, the Americans ruled the world. So when the largest economy in the world changes, invariably the reserve currency changes. The pound sterling, just to remind you, was reserve currency till the Second World War, and it takes typically, as per McKinsey, between 14 to 17 years after change of regime that the country loses its status as a reserve currency. So about 14 to 17 years after the Second World War is when the pound sterling was not a default currency in the world, or the poundization became a dollarization, so to say. Where we stand today, as I mentioned to you, it's a question of time, depending on looking at 4 to 7 years from now, when China will become the largest economy in the world. So the dollarization thing would come down. Would it take 14 to 17 years? I do not know. Personally, I do not believe it so. But I also want to caveat to you, it's not necessary that Chinese yuan will become reserve currency, because the way the currency works is also changing sharply. And I just want to close this thing to take other questions, is that remember, today, because of blockchain and CBDC is called central bank backed digital currencies, the use of the reserve currency sector would change. So the way the whole gamut of things will work will be sharply different from the way we have been using our reserve currencies out there.
Thank you, Sanjay ji. Second question from Mr. Kazi. For an individual investor looking for a short period investment of 1 year only, what would be your advice? Only for investment for 1 year in fixed instruments.
See, like, look, I'm not legally authorized to give investment advice. That's something which I would defer it to the wealth managers. What I will say to you is this way. Let me ask a question to you and let's get an answer. So we all know the GDP of the country will come down, right? What is GDP? GDP is the turnover of the companies. Right? So turnover of the company will come down. When turnover comes down, what happens? Net profit comes down. All companies have operating leverage. In other language, fixed cost, right? Because all companies fixed cost, therefore have operating leverage. Therefore, when the turnover comes down, the net profit comes down at a higher rate. Agreed? So if the net profit comes down, EPS will come down. If your EPS is coming down, the P expectation will come down. So if your EPS comes down, your P expectation comes down, then what happens to equity market? it has to come down, right? So from that point of view, it's no brainer that you should be looking into fixed income space. So the big picture is right. Now comes to the in 1 year, where you should look at. Right? So depending on how good a value you understand, you can even take a government treasuries, which is giving fantastic return for a couple of years, right? So if you're looking only in terms of 1 year time horizon, then you can look in terms of safest of safe assets, because the yield curve is inverted. Namely, you could make good money in investing in short-term proposition. If your horizon is slightly longer period of time, then of course it's very, very important to be more diversified, which we could do.
Thank you, Sanjay. Third is slightly a big question. I'll quickly read. It is from Mr. Rajiv Shah. Hi, Sanjay. Agreed that at a peak of interest rate, it is good to invest in bond funds, as some good bonds are available at below par value. But could you also talk about some other factors other than interest rates influencing bond fund like yours? There have been cases during COVID time, for example, where a fall in bond funds have been due to forced margin calls in equity markets. Are there any early indicators or analytical correlation patterns available that can prompt such kind of cross-market margin call risks? Very technical question.
Okay, so let me divide into few pieces. So there are two aspects of the question, primarily speaking. So I'll cover both aspects separately. So first is that where we stand today, even a monkey can make money, as we call in our team, because the yields are so elevated. If you buy any good investment, get bond, you're making a fantastic return. So that's not a big issue at all there. Are they quoting par value? Almost inevitably. Remember the SVB problem, when they invested, the yield was 1%, today yield is 4%. So obviously the bond value came down by 75% in case, the example which we took. So most of the bonds today in the market would be quoting significantly below the par value. As a layman, it's good to talk about it, but to be honest with you, with a hand on the heart, doesn't matter. For me, what matters is the YTM. Right? So if a bond is giving me, simplifying, a YTM of 8% and scoring 102, I'd rather buy that bond rather than bond which is giving me 3% and quoting at a 99 cents to $1. So for me, as a investment professional, I would be more focused in terms of the YTM aspect of it. The second thing he talked about in terms of the early signs of some events happening across out there. So I'll divide the events in two portions. One is a black swan event like COVID. By definition, black swan event is a black swan event. If I could define it, it would not be a black swan. So that's a classic Draupadi's question in the Rajya Sabha. So the point is that no, we cannot plan for any COVID, and we should not plan for any COVID, because the fact that if you take COVID into consideration in your portfolio construction, you will end up having a risk-free rate. You can't get more than that. Right? The smart thing to do is that rather than planning for COVID such a situation, you do what's basically called scenario analysis. Right? Look from scenario analysis point of view into risk, what's that value at risk, or what we typically talk about, loss given default. Look from those provisions. It's very technical, but that's what it is. So I talked about 2 points. One was, of course, in terms of the black swan event like COVID. Other is which is more important, which is more pertinent also. And the answer to that is the frog in a boiling water. If you keep the frog and slowly increase the temperature of the water, the frog will die of heat rather than jumping from the water. So what's happening in the world is actually, sadly so, and this is my personal view, is that the boiling water. People got so used to buy on dip that the world has changed. They're still talking buy a dip. I say, hold on. Do you know the amount of bankruptcies we are talking in US in the first 2 months is more than we saw in the entire 2022? In 2 months. 10 months are still pending. Yes, it doesn't hurt you and me. Why? Because small companies. It's like COVID time. the bottom of the pyramid got hurt. All of us, the chartered accountant, the finance, the IT people got a lot of money from government of India, government of Bahrain, government of Oman, wherever you are, right? The bottom of the pyramid. So bottom of pyramid point of view, please appreciate we have more bankruptcies in the first 2 months than the entire year of 2022, and more bankruptcies in the first 2 months than ever since in last 12 years. So if you're asking question to me, yes, this is what we are seeing in reality. Does it impact my investment decision? Again, sadly, no. Why sadly no? Because inevitably, when the small people die, it benefits the big boys. Am I proud of it? No, I'm not proud. But I'm a professional. That's the stark truth. So there is a flight of deposit, for example, from regional banks to larger banks. We see the same thing happening. The larger companies will get more market share, become better. But is very important. How do you go from current period to that period where the big becomes bigger or better, if you want to say so? In that period, you will see the default rate increasing. So if you remember the graphic which I showed you earlier, we talked about the default rate actually increasing. And I didn't want to emphasize, I didn't want to scare you, because relatively speaking, it's still far, far low than it should be. Here it is. So if you notice here, look at these numbers. So if you notice that the default rate we're talking about actually increased significantly, didn't it? So from 1.6 to 2.1. But the key point here is that even after increase, it is significantly below 3.5. Therefore, from the risk reward point of view, it's brilliant times. Right? And relatively, of course, is much, much better. Hope that answers the question.
Thank you, Sanjay ji. We have a question from Rajiv Shah regarding financial sector. He is asking, in SBF, allocation to financial sector is around 55%, which is quite high. You also mentioned about high risk in banking sectors. So what comfort factors one should look at while selecting investment grade bonds in financial sector?
Okay, so let me take the graphic which Rajiv ji is referring to, so that all of us on the same page. Give me a second. Here it is. So this is the graph Rajiv ji is referring to. No, sorry, not this one. So he's talking about the finance sector being a very big sector. So I want to clarify two portions. First is purely technical. So this classification is as per Bloomberg. And the way the Bloomberg classifies, if the issuer is a finance company, it will be deemed to be financial. And there's a lot of ifs and buts. So take what I'm saying with a pinch of salt. So the way it works is this. If there is a manufacturing company which is subsidiary, which raises money, a sector out there, in many places we deem to be a finance company. For example, a real estate company, we don't have a sector called real estate in the Bloomberg classification, which I'm referring to. So real estate company we deem to a finance company. Right? So just keep be aware that the definition itself has an issue. As I mentioned you, 2 points. One is the definition has an issue. Just be careful across that there. There are, of course, multiple ways we could do a sector allocation. We thought it to be most proper to do it as per Bloomberg rather than creating our own classification, so to say. The second thing is also important. Remember, one of the largest issuers of finance or creation of credits are banks. Right? They create the credit to be able to give loans to the sector out there. So by default, they will be the largest, one of the larger issues in the sector out there. And that is where I told in my message that, look, in case of doubt, call the doctor. So you require to have expertise to understand, what does 81 means? What does the TLAC means? What the 82 means? What difference between secured? What is the difference between senior secured? What does it mean senior unsecured? These are the nomenclatures which are you need to be understanding very, very well in reality. What does it mean? And it is sad, and I say with deep pain. And the reason I'm saying is that this is not the first time talking to friends. I've been doing this for more than 25 years. And it pains to me that in class 10th, we are taught about H2O and how CO2 as a sector works, the chemical equation, which we hardly ever use in our lifetime, but nobody teaches the basics in terms of investment, which we have to do whether we love it or not love it. Isn't sad? The financial literacy is something which we don't even focus upon. Now, good news, of course, is that many of the developed world governments have woken up. In Singapore, for example, we have financial literacy coming into primary schools in a sector out there, but there's something which is very, very important. So coming back to the point which I put on the table is that, sir, good, bad, ugly, you need to know what you're investing into. And if you can invest into the way we gave you the example of Credit Suisse, you could still withstand the turmoils in the market. And it's worth for you to apply the time and energy to understand how these things work.
Thank you, Sanjay ji. In the graph, we saw around 58% allocation in India and around 5% in Australia. So we'll take up this next question by Gopal Subramanian. How safe are the equity and bonds investments in Australian and New Zealand securities market? He means to ask reward versus return for medium to long term range.
Okay, so I have a problem because in terms of numbers, how much numbers I can share. Okay, so let me give this thing to you. So in terms of India, I assume you know about it. India is doing pretty well. The financial credit metrics, India is improved very, very sharply. So it makes tremendous sense for you to look into India. David, be very, very acutely aware of the concentration risk. Because being Institute of Chartered Accountants of India, all of us have some roots in India. So you inevitably have exposure to the economy. So make sure that as a family, your exposure is something which, or concentration which you have to India is something which you are comfortable with. Coming to Australia and in New Zealand, Australia in particular has one of the most capitalized banks in the world. They have the highest CET ratios. And of course, because of the turmoil, like all economies go, they have gone through turmoil roughly about 6 years ago. So they become still better banks sector out there. So from the risk reward point of view, the banking sector in Australia, whether it's Westpac, whether the ANZs or Macquarie's of the world, their financial ratios are far superior than most of the other financial institutions in the world. And for what you call return per unit of risk point of view, again, the Australian banks make tremendous sense. We also have very interesting REITs in that region. Just to remind you, Australia is one of the large REIT markets in the world, which also have a huge potential in terms of what you could be investing into.
Thanks, Sanjay, for enlightening our members. I'll request Vice Chairman CA Jim for a felicitation and formal vote of thanks.
Thank you, Ashish. As we all know, yesterday Indian indexes closed for the year with a slight negative note, and whereas the bank fixed deposits are giving 6 to 8% interest. So retailers and our members are also looking for different avenues or new avenues. So I think it is the right time to discuss about the debt funds and bond funds. And taking your word, Sanjay ji, I think we called the doctor at the right time. So thanks very much for the very insightful presentation. On behalf of everybody gathered here and on behalf of the chapter, I extend thanks to you. Kindly accept this e-certificate.
Thank you, sir.
Thank you.
It's my privilege to be able to address my fellow chartered accountants and friends. I'm grateful to Muscat chapter of Chartered Accountants of India for the opportunity. And I'm always available to members and friends in terms of whatever I can contribute in terms of understanding of fixed income. It's a privilege. Thank you very, very much. And for each of the audience who have taken time to today be with us. Thank you once again.
I'll stop the recording now.
Let me proceed with the completion of the vote of thanks. Thanks to C. Atul Kumar Gupta ji for joining us today. Thanks to Silverdale Funds for support. Thanks to Ashish ji for wonderful moderating the session. And thanks to CBFS, our sponsors, our corporate members. And thanks to all the members for joining today. Thank you very much.
Thank you, Sanjay ji. We'll be in touch. Thanks a lot.
Thank you. It was a wonderful session.
My pleasure. Thank you, sir. Thank you very much.